Today, the Bears are back in town for now. Hello again, it's Martin North from Digital Finance Analytics, one that is posts covering finance and problem news with a distinctively Australian flavour. Well, Wall Street ended sharply lower on Monday as investors fretted about a US Federal Reserve gathering later in the week at Jackson Hole that's expected to reinforce a strong commitment by the central bank to stamp out inflation. The pullback is gathering momentum, even as European natural gas prices go vertical and China announces plans to offer $23 billion in special loans to troubled developers. So you can make a good case that the market is rerunning the early stages of some of the strong bull markets of recent years, but if you look at the bear markets that started in 2000 and 2008, and you'll see plenty of rallies that looked just like we've had recently before resuming their downward path. V-shaped rebounds are typical of both early-stage bull markets and bear market rallies, as this chart from Fidelity highlights. And in fact, it looks to me as though the bears are back in town. The Dow Jones Industrial Average slipped 1.9%, the Nasdaq was down 2.6%, and the S&P 500 fell 2.1%. Tech stocks picked up from where they left off last week as rising Treasury yields, the enemy of stocks that have high valuations, piled on the pressure with just days to go until that Federal Reserve discussion, which will perhaps deliver fresh clues on monetary policy at its annual Jackson Hole Symposium. All 11 S&P 500 sector indices declined, led lower by consumer discretionary down 2.84% and 2.78% in IT. The 10-year bond sat at 3.02, while the 2-year was at 3.3077, continuing to underscore a potential recession. Nvidia dropped 4.6%, Amazon.com fell 3.6%, while Microsoft and Apple each lost more than 2% as the benchmark 10-year US Treasury yield rose to its highest level since July 21. Netflix fell more than 6% after CFRA downgraded the stock to sell from hold and cut its price target on the stock to $238 from $345 on worries that the streaming giant's earnings will decline in the second half of the year. Ford Motor, meanwhile, dragged consumer stocks lower as the automaker was ordered to pay $1.7 billion to the family of Von Seil and Melvin Hill, who were killed in a fatal rollover of an F-250 pickup truck. The automaker also said it would slash 3,000 jobs in the US and Canada. AMC Entertainment Holdings tumbled 42% after the cinema chain's preferred stock listing started trading, and its UK-based rival Cineworld Group warned of a possible bankruptcy filing. Energy was the relatively outperforming sector of the day, down just 0.2% as oil prices recovered losses after Saudi energy ministers touted the prospect of major oil producers cutting costs to ensure that oil futures prices reflect the current demand and supply fundamentals. WTI oil was up 0.9% to 91.17, while Brent was up 0.49% to 97.18. After a summer rally on Wall Street ended last week, the S&P 500 remains down about 13% so far in 2022, and the Nasdaq is down more than 20%, and the volatility index rose to 23.9. That's the highest in over 2 weeks. So focus is now on Fed Chair Jerome Powell's speech on Friday at the Central Banking Conference in Jackson Hole for further clues as to how aggressively the Fed is likely to be with interest rate hikes. Powell is going to try to sound hawkish to tamp down inflationary expectations and tighten financial conditions. So that's most likely going to be a negative catalyst for the market, warned Jay Hatfield, Chief Investment Officer at Infrastructure Capital Management in New York. The Fed will probably raise interest rates by 50 basis points in September, according to economists, though traders are now split between 50 and 75, by the central bank after several policymakers recently pushed back against expectations of a dovish pivot and emphasised the Fed's commitment to fight against inflation. Investors will also be looking for details on the Fed's plan to reduce its nearly $9 trillion balance sheet, a process that actually started in June. And slowdown fears actually hit markets globally. For example, China's central bank trimmed some key lending interest rates on Monday in a bid to support a slowing economy and a stressed housing sector. And China will offer 200 billion yuan, which is $29.3 billion, in special loans to ensure stalled housing projects are delivered to buyers, ramping up financing support for its beleaguered property sector. The previously unreported size of the lending program, which was announced with scant details by China's housing ministry and the central bank late on Friday, would make it the biggest financial commitment yet from Beijing to contain a property crisis that's seen home prices slump and real estate sales plummet. Hundreds of thousands of middle-class Chinese have been caught in limbo after making down payments and taking out loans on properties that cash-strapped developers are now struggling to complete. Some home buyers have started to boycott mortgage payments, a threat to social stability during the politically sensitive run-up to the Communist Party leadership transition later this year. The People's Bank of China and the Ministry of Finance will channel the money through policy banks such as China Development Bank and Agricultural Development Bank of China. And also bleeding into negative sentiment on Wall Street, European shares dropped after Russia's Gazprom said last week that it would halt natural gas supplies to Europe for 3 days at the end of August. The pipeline is expected to be closed from August the 31st, but it raises concerns that the link won't return to service as planned after the works. Prices were up 44.9% in August alone. Benchmark gas settled at a record high, while German power surged to above 700 euros a megawatt hour for the first time. And in one of the most dire warnings yet, Belgian Prime Minister Alexander De Croo said Europe could face up to 10 difficult winters. It would put sustained stress on major economies and leave thousands of households struggling to pay their bills. Concerns over the economy pushed the euro currency to a 2-decade low on Monday, while inflation is at the highest in years. And gold futures finished the session on Monday at $1,748, down $14.50 or 0.8%. Since its last positive close on August the 12th, the benchmark gold futures has lost just over $67 or 3.7%. The dollar index, which pits the greenback against 6 majors, led by the euro, hit a 6-week high of 109.06. And gold's latest slide came as investors awaited insights on the future path of interest rates from that speech by the Federal Reserve at Jackson Hole. Powell's speech could shake up markets, with the rally in US equities already showing signs of slowing. And US economic data will be in the spotlight also as fears over the prospects of a recession linger. Meanwhile, PMI data out of the Eurozone and the UK will also point potentially to further slowdowns in business activity. Gold prices are weakening as King dollar returns and as investors brace for a potentially hawkish speech by Fed Chair Powell at Jackson Hole, said Ed Moyer, analyst at online trading platform Onya. Gold will eventually settle on a trading range, but it seems the floor might be a little lower as the risks of energy and food inflation could keep the Fed remaining aggressive with rate hikes into the new year. The Fed has hiked interest rates by 225 basis points since March in a bid to battle inflation, which is running at the highest in 4 decades. Fed policymakers have reiterated that there is still a way to go in their inflation fight, pushing back on expectations of a peak in inflation and a so-called dovish pivot. Now that's, of course, been a narrative that helped boost stocks recently. Last week's Fed minutes showed that while the size of the September rate hike is still in play, policymakers felt there was little evidence so far that inflation pressures are subsiding. So Powell is likely to remind investors that one more inflation report, another employment report, still has to come before the September meeting, so officials have time to decide how large that rate hike should be. And the economic calendar for the coming week features July figures on personal income and spending in the US, which includes personal consumption expenditures price indices, the Fed's preferred measure of inflation. In the 12 months through to June, the PCE price index was up 6.8%. That's the largest increase since January 1982. And other data points include figures on revised second quarter gross domestic product, which initially showed a contraction of 0.9%. And there will also be reports on durable goods orders, initial jobless claims, and PMI data for July. Meantime, data on new home sales in the US will shed yet more light on the potential cooling housing market. So for now at least, it does seem to me that the bears are back in town, and of course we'll all be waiting for Powell to deliver his missive later in the week and see how the markets react to that. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.